Today, I will discuss operating and financial leases and show an example that compares leasing versus purchasing a small tractor. An operating lease offers an alternative for acquiring the use of machinery without owning it. An operating lease is often a short-term rental arrangement. The rental charge is usually based on units of work such as dollars per acre or dollars per hour. The leasing company owns the machinery and usually pays for all repairs and maintenance. The farmer leasing the equipment usually pays for fuel and provides all labor. For tax purposes, you can deduct the cost of leasing equipment, but you cannot deduct depreciation expenses since you do not own the equipment. Operating leases are common on general purpose items such as tractors, which are used many times during the year. Seasonal operating leases for tractors and combines are quite common. In some areas, short-term leases are only available on excess inventory. Machinery availability may be an added risk for these types of agreements. A financial lease is a long-term contract, usually for the useful life of the machinery. The farmer has exclusive rights to use the equipment or machinery. Because the lease is a long-term agreement, it may be costly to end the lease agreement early. A financial lease is quite similar to an outright purchase. Under a financial lease, the farmer pays all repair, maintenance, and operating costs. Options at the end of the lease period can include purchase of the asset for an amount specified at the time the lease is signed, purchase at fair market value, renew the lease, or return the equipment to the lessor. In this example, we compare the annual payments of a lease and a loan. If someone were considering buying a small utility tractor that costs $52,100, they can either lease it or purchase it outright with a loan. Both options require a 10% down payment and a loan amount of $46,890. Both options have an interest rate of 6.48% and last for 7 years. When comparing the two options, the annual loan payment is over $3,300 more than the annual lease payment. When looking at financing options, producers may want to consider both leasing and purchasing. The lease option reduces annual cash flows, but leaves the producer without owning any equipment at the end of the lease. If regularly replacing equipment, this may be a useful option for gaining the use of a tractor. Equipment manufacturers and dealers may have calculators on their website to calculate and compare lease payments and loan payments. Here we are using our previous example of a small utility tractor purchase for $52,000 with a 7-year loan. This example compares deductions under two different depreciation options. The producer could depreciate and take the deduction over 7 years, giving them multiple smaller annual deductions. Or they could take one large deduction by depreciating 100% of the tractor purchase in the first year. If this tractor were purchased in a year when commodity prices, revenue, and taxable income are high, it might be desirable to depreciate all of the purchase the first year to reduce high taxable income. If it were purchased in a time of challenging commodity prices, farm revenue, and farm income, it might make sense to stretch out the depreciation and deductions over a longer time to get the benefit both now and in the future when taxable income increases. As a reminder, always consult with your tax professional before deciding on deduction, depreciation, and tax strategies. Another option is custom hiring work when a piece of equipment is needed but not owned. Custom work is defined as machine operations performed for the customer, with the custom operator furnishing the machine, fuel, labor, and other inputs directly associated with the machine. Custom operators do not usually furnish material such as seed or fertilizer unless it is explicitly stated. When considering this option or negotiating for custom work to be done, a good source of information for determining farm and ranch custom rates in Oklahoma is Current Report 205. It summarizes data based on a survey of farmers, ranchers, and custom operators done every 2 years. This data can provide a starting point for determining cost and rates in a lease arrangement. Here is an example of some of the information found in the Custom Rate Current Report. It contains both state and regional average prices for tillage operations, chemical applications, planting, and more. For additional information on this and other farm management topics, visit the eFarm Management website. Timely information may also be found on the OSU Farm Management Facebook page. Publications from the Oklahoma Cooperative Extension Service are another source of information. These publications may be found at factsheets.okstate.edu.